Have you ever felt it? Is that knot in your stomach as you watch the market news? A ticker flashes green. A new crypto coin is soaring. Some company you've never heard of just doubled overnight. Your friends are talking about their gains. A cousin just paid off their car with a single stock trade. And you feel like you're standing on the sidelines of the biggest wealth creation event in human history, completely paralyzed. Paralyzed by fear. Fear of losing everything you've worked so hard for. Fear of making a stupid mistake. Fear of being the one person who buys at the top, right before the crash. And paralyzed by confusion. What's the difference between an ETF and a mutual fund? What do PE ratios even mean? Is now a good time to buy or a bad time? The advice is a roaring tidal wave of contradiction. By the dip, the sky is falling. This time it's different. So you do nothing? You let your money sit, slowly being eaten away by inflation? You watch, feeling a toxic mix of envy and anxiety, convinced that the game of wealth is rigged for insiders? For geniuses, for people who are braver or smarter than you. What if I told you that feeling? That paralysis is a lie. What if I told you that the entire chaotic, terrifying, casino-like world of Wall Street could be simplified down to a single, timeless philosophy? A philosophy so powerful, so logical, that it has guided the most successful investors on the planet for nearly a century. What if you could trade that fear for confidence? Trade that confusion for clarity? What if you could build a fortress around your financial future? One that doesn't just withstand the storms of the market, but actually grows stronger because of them. That is not a sales pitch. That is a promise. And the key to unlocking it is held within the pages of a single book. The book is called The Intelligent Investor. And the author, Benjamin Graham, is not just another writer. He is the father of modern investing, the mentor to Warren Buffett. He is the architect of the very framework that separates gamblers from builders, speculators from owners. This book, written decades ago, is more relevant today than ever before. In an age of meme stocks, crypto hype, and 24/7 financial news designed to trigger your worst impulses, this book is not just a guide, it is a shield. It is a mental operating system. We are not going to review this book. We are going to install it. We are going to rewire your brain to see the world of money not as a source of fear, but as a source of opportunity. We're going to dismantle the casino and replace it with a blueprint for building real, lasting wealth. This isn't about picking hot stocks. It's about developing a cold mind. It's about building a character that is disciplined, patient, and resilient. Because Graham's secret is this: successful investing has less to do with your IQ and more to do with your emotional fortitude. This is your masterclass. Your transformation begins now. We will walk through this legendary text, chapter by chapter and piece by piece. We will build you into the one thing that can guarantee your financial success: an intelligent investor. Here is our journey. Chapter 1. Investment versus speculation. Results to be expected by the intelligent investor. Chapter 2. The investor and inflation. Chapter 3. A century of stock market history. The level of stock prices in early 1972. Chapter 4. General portfolio policy. The defensive investor. Chapter 5. The defensive investor and common stocks. Chapter 6. Portfolio policy for the enterprising investor. Negative approach. Chapter 7. Portfolio policy for the enterprising investor. The positive side. Chapter 8. The investor and market fluctuations. Chapter 9. Investing in investment funds. Chapter 10. The investor and his advisors. Chapter 11. Security analysis for the lay investor. General approach. Chapter 12. Things to consider about per-share earnings. Chapter 13. A comparison of 4 listed companies. Chapter 14. Stock selection for the defensive investor. Chapter 15. Stock selection for the enterprising investor. Chapter 16. Convertible issues and warrants. Chapter 17. For extremely instructive case histories. Chapter 18. A comparison of 8 pairs of companies. Chapter 19. Shareholders and managements. Dividend policy. Chapter 20. Margin of safety as the central concept of investment. Let's begin this journey, one chapter at a time. Chapter 1. Investment versus speculation. Results to be expected by the intelligent investor. What is the single most important decision you will ever make with your money? It's not which stock to buy. It's not which fund to choose. It's this. Are you an investor or are you a speculator? This is the foundation of everything. Get this wrong, and you are destined for a life of anxiety and probable loss. Get this right, and you are on the path to financial freedom. Graham lays it out with brutal clarity. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Let's translate that. Think of it like this. An investor is a business partner. A speculator is a casino gambler. The business partner, the investor, buys a piece of a company. They study the business. They look at its debts, its profits, its management, its position in the marketplace. They ask, is this a durable, profitable enterprise that I want to own for the long haul? Their success depends on the long-term success of the business. They are buying a future stream of cash flow. The casino gambler, the speculator, doesn't care about the business. They only care about the price of the little ticker symbol on the screen. They are betting that the price will go up in the short term, for whatever reason. Maybe there's a rumor, or maybe a celebrity tweeted about it. Maybe the chart just looks like it's ready to pop. Their success depends on predicting the psychology of a crowd. They are not buying a business. They are betting on a number. You have to ask yourself, right now, which one are you? Be honest. When you think about buying a stock, are you thinking about the price next week or the value of the business in the next decade? Speculation is intoxicating. It's the thrill of the chase. It's the lure of fast, easy money. But Graham warns us that it's a siren song. Trying to outsmart the market to time its zigs and zags is a full-time, a stressed job that even the most brilliant professionals fail at consistently. For the intelligent investor, the game is different. You are not trying to predict the rain. You are building an ark. You don't guess. You calculate. You don't hope. You analyze. This first chapter is a line in the sand. You must choose your side. Are you here to gamble on price fluctuations, or are you here to own pieces of productive real-world businesses? Everything that follows in this book, every strategy, every piece of advice, is built on the assumption that you have made the right choice. That you have chosen to be an owner, not a gambler, a partner, not a player. This is your first mental shift. Stop looking at the stock market as a casino. Start looking at it as a marketplace of businesses available for you to own. Chapter 2. The Investor and Inflation. What is the silent thief that robs you of your future? It's not a stock market crash. It's not a bad investment. It's a slow, creeping, invisible force called inflation. It's the reason that the money you've diligently saved in a bank account is worth less and less every single day. Holding cash is a guaranteed loss. Graham understood this perfectly. The challenge for the investor isn't just to make money. It's to make your money grow faster than its purchasing power shrinks. Think of your wealth as a block of ice on a warm day. Just leaving it there means it will melt. Your job isn't just to protect it from being stolen. It's to move it into a freezer where it can grow. This is where stocks come in, but not in the way speculators see them. For the intelligent investor, stocks are not just pieces of paper. They are a claim on real assets, real factories, real brands, real patents, real pricing power. When the cost of everything goes up, labor, materials, energy, a good business can raise its prices to match. A well-run company is an inflation-fighting machine. Your cash in the bank, it can't raise its prices. Its value is fixed and eroding. This is a fundamental truth you must accept. To protect yourself from inflation, you must own things. You must own productive assets, common stocks, when purchased intelligently, the most accessible and powerful productive assets for the average person. But Graham offers a crucial warning. Just because stocks are a good long-term hedge against inflation doesn't mean you can buy them at any price. People get terrified of inflation and rush to buy stocks at insane valuations, thinking any price is better than holding cash. This is a fatal mistake. Paying too much for a good asset can be just as destructive as buying a bad one. So the lesson here is twofold. First, You must accept the necessity of owning stocks to outpace the silent thief of inflation. Staying in cash is not safe. It is a guaranteed road to poverty. Second, you must maintain the discipline to not overpay, even when fear is screaming at you to buy at any cost. Your goal is not just to own stocks, but to own them at prices that make business sense. This is how you defeat inflation without becoming a victim of market euphoria. Chapter 3. A Century of Stock Market History. The level of stock prices in early 1972. Have you ever thought to yourself, the market is too high? I'll wait for a crash. Or the market is crashing. I'm getting out now. If you have, you're trying to do the impossible, predict the future. In this chapter, Graham does something profound. He walks us through a century of market history, not to give us a crystal ball, but to give us a map of the terrain. He shows us that markets have always moved in wild emotional cycles. Periods of giddy optimism are always followed by depths of gut-wrenching despair. Always. The point of looking at history is not to say, in 1929 it did this, so in 2029 it will do that. The point is to immunize yourself against the two most dangerous phrases in finance. This time it's different. When the market is soaring, you will hear people say, this time it's different. We have new technology, new paradigms. The old rules don't apply. When the market is crashing, you will hear people say, this time it's different. The financial system is broken. Capitalism is ending. It's never coming back. Graham, with a century of data, shows us that it is never different. The emotional pendulum of fear and greed always swings. Human nature does not change. So what does the intelligent investor do with this knowledge? You stop trying to predict the swing of the pendulum. Instead, you prepare for it. You internalize the fact that crashes will happen. You accept that euphoric bubbles will form. These are not anomalies. They are the character of the market itself. Imagine you're a ship captain. You don't control the weather. You know there will be sunny days, and you know there will be violent hurricanes. A foolish captain looks at a sunny sky and says, there will be no more storms. A wise captain uses the sunny days to check the lifeboats, patch the hull, and train the crew. This chapter is your training. It's the historical data that proves you must be prepared. It liberates you from the impossible burden of prediction and replaces it with the manageable task of preparation. You will see crashes in your lifetime. You will see bubbles. Thanks to this lesson, you will not be surprised. You will not panic. You will be ready. Chapter 4. General Portfolio Policy. The Defensive Investor. Who are you as an investor? I mean, really. This is where Graham asks you to look in the mirror and have an honest conversation with yourself. He divides the entire investing world into two camps, not rich and poor, not young and old, but the defensive investor and the enterprising investor. Your first, most crucial task is to determine which one you are. And it has nothing to do with how smart you are. It has everything to do with how much time, effort, and emotional energy you are willing and able to commit to the process. Let's start with the defensive investor. Graham calls this investor passive, but a better word is strategic. This is the fortress builder. The defensive investor has a primary goal: to avoid serious mistakes or losses and to achieve average, but reliable returns with minimal effort and minimal stress. This is the person with a demanding full-time job, a family, hobbies, a life. They don't have the time or the desire to spend their weekends poring over financial statements. They want a simple, proven set of hand. Almost forgets its strategy. Their core strategy is simple but powerful. Create a balanced portfolio. It's typically split between high-grade bonds and a diversified basket of leading stocks. Graham suggests a 50-50th split as a baseline. Why this split? It's a thermostat for your risk and emotions. When the stock market is soaring and everyone is greedy, the 50-50ths rule forces you to sell some of your winning stocks and buy more bonds to get back to your 50-50ths balance. It forces you to sell high. When the stock market is crashing and everyone is terrified, your stock portion has shrunk. The rule forces you to sell some of your stable bonds and buy more stocks at bargain prices to rebalance. It forces you to buy low. This simple, automatic rebalancing is a behavioral masterpiece. It forces you to act rationally when your brain is screaming at you to do the exact opposite. It makes discipline automatic. Being a defensive investor is not a consolation prize. It is a winning strategy for the vast majority of people. It's about building a financial fortress that can withstand any economic weather. Protecting your capital and allowing it to grow steadily over time without dominating your life. Are you this person? Are you the fortress builder? Be honest, because choosing the right path is the key to your peace of mind. Chapter 5. The Defensive Investor in Common Stocks. So, you've decided you're the defensive investor, the fortress builder. How do you actually choose the stocks that go inside your fortress? Remember the goal? Safety, simplicity, and reliable returns? This is not the time for adventure. Right? This is the time for stability. Graham gives the defensive investor a clear, simple set of rules. Think of this as the pre-flight checklist for your money. You don't deviate from it. You just execute it. First, adequate diversification. Don't put all your eggs in one basket. Graham suggests owning between 10 and 30 different stocks. This protects you from the risk of a single company failing unexpectedly. If one of your stocks goes to zero, it won't sink your entire portfolio. In today's world, a simple, low-cost S&P 500 index fund accomplishes this perfectly. You instantly own a piece of 500 of America's largest companies. It is the ultimate diversification. Second, stick to large, prominent, and conservatively financed companies. We're talking about the leaders of the industry, the household names. Companies that have been around for a long time and have a proven track record of profitability in navigating tough economic times. Why? Because they are more resilient. They have the financial muscle to survive recessions and the market power to fend off competition. This isn't the place to bet on the hot new startup. Third, a long record of continuous dividend payments. Graham loves dividends. Why? A dividend is cold, hard cash in your pocket. It's proof that a company is actually profitable. A company can fudge its earnings reports, but it can't fake a cash dividend payment. A long history of paying and even increasing dividends is a powerful signal of financial health and a management team that cares about its shareholders. Fourth, a limit on the price you are willing to pay. This is crucial. Even the best company in the world is a bad investment if you overpay for it. Graham set specific limits based on past earnings. For example, not paying more than 25 times average earnings over the last 7 years and not more than 20 times the last 12 months. The exact numbers change, but the principle is timeless. Don't get swept up in euphoria. Have a hard ceiling on what you're willing to pay and stick to it. This is it. This is the entire strategy. It's simple. It might even sound boring, but it is powerful. It is designed to protect you from the single greatest enemy of your wealth. You. Your emotions, your greed, your fear. The defensive investor wins by not losing. By building a simple, robust portfolio of quality businesses bought at reasonable prices and letting the power of time and compound interest do the heavy lifting. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. Now, let's talk about the other path. It's the path of the enterprising investor, the expedition leader. Before we talk about what this investor does, Graham starts with a powerful chapter on what they must not do. This is your list of landmines to avoid. Who is the enterprising investor? This is someone who is willing and able to devote serious time and intellectual effort to the craft of investing. They're not looking for average returns. They're aiming to do better than the passive investor. But with great ambition comes great danger. Graham's first warnings are like a series of giant, flashing red lights. First, avoid lower quality bonds and preferred stocks just because they offer a slightly higher yield. This is what Graham calls picking up pennies in front of a steamroller. You're taking on a huge amount of hidden risk for a tiny bit of extra income. When things go bad, these are the instruments that collapse. The intelligent enterprise is about finding undervalued opportunities, not picking up higher risk garbage. Second, and this is a big one for today's world, beware the initial public offering. The IPO. An IPO is when a private company first sells its shares to the public. The hype is enormous. The stories of overnight millionaires are seductive, but Graham points out the fundamental flaw. IPOs are almost always timed to benefit the sellers, not the buyers. The company goes public when the market is hot and they can get the highest possible price. You, the buyer, are systematically being offered a deal at the worst possible time. Can you get lucky with an IPO? Sure. Is it a reliable strategy for building wealth? Absolutely not. It is speculation in its purest form. Third, avoid junk stocks. This seems obvious, but people fall for it all the time. They buy a stock that has fallen 90%, thinking it can't go any lower. Oh yes, it can. Stock that falls 90% can fall another 90%. The enterprising investor's job is not to rummage through the trash heap hoping to find a discarded lottery ticket. Their job is to find quality businesses that are temporarily mispriced. There is a world of difference. This chapter is a filter. It's about eliminating the losing bets before you even start looking for the winning ones. The enterprising investor's first job is risk management. It's saying no 99 times so that the one yes is a calculated, intelligent decision. If you read this list of don'ts and feel a thrill at the idea of chasing IPOs or bottom fishing for nearly bankrupt companies, you are not an enterprising investor. You are a speculator, and you need to go back to the defensive path before you get hurt. This negative approach is the foundation of enterprise. Know the traps. Avoid them at all costs. Only then can you begin to search for real opportunity. Chapter 7. Portfolio Policy for the Enterprising Investor. The positive side. If you've made it past the warnings. If you have the time, the temperament, and the discipline, then what does the enterprising investor actually do? How do you actively hunt for opportunities that the market has overlooked? This is where you move from being a fortress builder to an expedition leader. You are actively searching for undervalued assets. Graham lays out several potential hunting grounds. The first is buying in depressed markets and selling in boom markets. This sounds simple, but it's emotionally brutal. This is the rebalancing act of the defensive investor, but on steroids. It requires the iron-willed discipline to buy when the news is apocalyptic and sell when the headlines are euphoric. It's psychologically the hardest thing to do in finance. The second is the careful purchase of growth stocks. Notice the word careful. Graham is not against growth. He's against paying a speculative price for growth. Everyone knows the big, fast-growing companies. Because everyone knows about them, their future growth is often more than fully priced in. The enterprising investor's challenge is to find a growth company before it's the darling of Wall Street, or to find one that is being undervalued for some temporary reason. This requires deep, painstaking research. The third, and this is the heart of classic Graham-style investing, is buying bargain issues. These are companies that are trading for demonstrably less than their intrinsic value. This could be a company trading for less than its working capital and net stock. It's like buying $1 for 50 cents. These are rare, but they are the holy grail for the value investor. The key is that the value is based on hard, verifiable numbers on the balance sheet, not on rosy projections about the future. The fourth area is special situations, or what we might call workout investments. This involves things like mergers, spin-offs, or bankruptcies, where the outcome of a specific corporate event will determine the value of the security. This is highly specialized work, almost like being a detective. It depends on legal and procedural knowledge, not on general market direction. Do you see the theme here? None of these are easy. None of them are based on a hot tip or a simple chart pattern. They all require one thing: work, art, analytical, unemotional work. Being an enterprising investor is like being a professional detective. You have to sift through mountains of evidence, follow up on leads, ignore the noise, and build a case. A case that a particular security is worth more than the market is currently offering. This is not a hobby. It is a serious discipline. If you are not excited by the prospect of this kind of detective work, that is a perfectly fine and rational response. It simply means your best path to wealth is the powerful, reliable path of the defensive investor. But if this challenge excites you, then your expedition awaits. Chapter 8. The Investor and Market Fluctuations. This is it. This is the single most important chapter for mastering your own psychology. If you can truly internalize this one lesson, you will have a greater advantage than 99% of all other market participants. The question is the market your master or your servant? Graham introduces us to the most brilliant investing analogy ever conceived, the parable of Mr. Market. Imagine you are business partners with a man named Mr. Market. He is a very accommodating partner. Every single day he comes to your office and offers to either buy your share of the business or sell you his share. The only problem? Mr. Market is a manic depressive. Some days he shows up in a state of wild euphoria. He sees nothing but a golden future for your business. On these days, he offers to buy your share for a ridiculously high price. Other days he shows up in the depths of despair. He is convinced the business is doomed and the world is ending. On these days, he is so desperate to get out that he offers to sell you his share for pennies on the dollar. He also has another trait. He doesn't mind being ignored. If you don't like his price today, he'll be back tomorrow with a completely new one. A speculator, a foolish person, lets Mr. Market be their master. They get infected by his mood. When Mr. Market is euphoric, they get euphoric too, and they eagerly buy from him at insane prices. When Mr. Market is despondent, they panic and sell their shares to him at rock-bottom prices. They let his irrationality dictate their actions. Intelligent investor does the opposite. The intelligent investor sees Mr. Market as their servant. You, the investor, have done your own homework. You know what the business is actually worth, based on its assets and earnings power? You have your own intrinsic value calculation. So, when Mr. Market shows up, you don't ask him for his opinion. You don't care about his mood swings. You simply look at the price he is offering. If he shows up screaming with panic and offers to sell you his share for a price far below your calculated value, you happily buy from him. Thank you, Mr. Market. If he shows up dancing with glee and offers to buy your share for a price far above your calculated value, you happily sell to him. Thank you, Mr. Market. And if his price is somewhere in the middle, neither a bargain nor an opportunity to sell, you do nothing. You ignore him. Go about your day knowing he'll be back tomorrow with another offer. This changes everything. You are no longer a victim of market swings. You are a beneficiary of them. The market's foolishness becomes your opportunity. Its volatility is not a risk. It is a source of profit. Stop looking at stock price quotes as a verdict on your intelligence. They are not a report card. They are simply the manic ravings of Mr. Market. You are free to ignore him or to take advantage of his folly. The choice is yours. Is he your master or is he your servant? Chapter 9. Investing in investment funds. For many people, the idea of analyzing individual companies is overwhelming. So what's the alternative? The world of investment funds, or, as we call them today, mutual funds and exchange-traded funds. Is this a smart shortcut or a dangerous trap? Graham sees funds as a potentially powerful tool, but one that requires the same intelligent approach as buying individual stocks. A fund is simply a basket of stocks or bonds managed by a professional. It offers instant diversification, which is a huge plus, especially for the defensive investor. But here's the catch. Which fund do you choose? There are thousands of them, all screaming for your attention with slick marketing and promises of market-beating performance. Graham cuts through the noise with a few timeless principles. First, performance. Don't be fooled by a fund that had one spectacular year. That's usually the result of luck, not skill. For consistency. How has the fund performed over a long period, say 5 or 10 years, through both good markets and bad? Does the manager protect capital during downturns? A fund that avoids big losses is often a better long-term bet than one that chases huge, risky gains. Second, and this is absolutely critical, costs. The fees a fund charges might seem small, 1% or 2% a year. But Graham shows that these costs are a relentless drag on your returns. They are a guaranteed headwind you have to overcome every single year. Over decades, these fees can consume a staggering portion of your wealth. Warren Buffett, Graham's student, has famously said that for most people, the best option is not a high-priced, actively managed fund. It is a simple, ultra-low-cost index fund. An index fund doesn't try to beat the market. It simply aims to match the market's return by holding all the stocks in a broad index. Like the S&P 500, because there's no high-paid manager trying to pick stocks, the fees are minuscule. By choosing a low-cost index fund, you are guaranteeing that you will capture nearly the entire return of the market itself. You will beat the vast majority of professional, high-FI fund managers over the long run simply by controlling the one thing you can control: your costs. So the lesson is this. Funds can be a fantastic tool for the intelligent investor, particularly the defensive one. But you must apply the same discipline. Don't chase hot performance. Don't get seduced by clever marketing. Focus on the two things that matter: a consistent long-term strategy, and above all, rock-bottom costs. Chapter 10. The Investor and His Advisors. Sooner or later, you might think about getting help. A financial advisor, a wealth manager, a stockbroker, should you? And if so, how do you choose one that will help you, not hurt you? Graham is extremely cautious here. He understood that the financial industry is filled with people who are motivated by sales commissions, not by your best interests. Think of it like this. Are you hiring a doctor or a salesman? A doctor diagnoses your problem and prescribes the best treatment, regardless of which drug company makes it. A salesman is paid to push a specific product, whether you need it or not. How can you tell the difference? First, look at how they are paid. An advisor who works on commission has a built-in conflict of interest. They make more money when you buy and sell frequently, or when they put you into high-fee products. A fee-only advisor, on the other hand, charges a flat fee or a percentage of the assets they manage. Their incentive is aligned with yours, to make your assets grow over the long term. This is a much healthier relationship. Second, what is their philosophy? Ask them about it. Does it sound like the principles in this book? Do they talk about market fluctuations as an opportunity? Do they emphasize the price you pay for an asset? Do they talk about a margin of safety? Or do they talk about market timing, hot trends, and complex strategies you don't understand? An advisor's true job is not to pick hot stocks for you. A good advisor is more like a personal trainer for your financial life. Their main role is to help you define your goals, create a sensible plan, and most importantly, protect you from yourself. They are the barrier between you and your worst emotional impulses. They are the person who tells you to stick to the plan when Mr. Market is having a panic attack. If you find an advisor who acts more like a behavioral coach than a stock-picking guru, who is transparent about their fees, and whose philosophy aligns with the timeless principles of intelligent investing, they can be an invaluable partner, but never ever cede your own judgment. The ultimate responsibility for your financial future is yours alone. An advisor is a guide, not a savior. You are the CEO of your own wealth. Use advisors to help you execute your plan, but never let anyone else write the plan for you. Chapter 11. Security Analysis for the Lay Investor. General Approach. All right, it's time to roll up our sleeves. How do you actually analyze a business? This might sound intimidating, like you need a PhD in finance. But Graham insists that a lay investor and everyday person can do this effectively. The goal here is not to become a Wall Street analyst. The goal is to develop a simple, robust framework to determine if a company is a reasonably safe and valuable investment. It's about asking the right questions. Think of yourself as a home buyer, not a stock picker. When you buy a house, you don't just look at a picture of it. You inspect the foundation. You check the plumbing. You look at the neighborhood. You compare its price to other houses nearby. You are performing house analysis. Security analysis is the same thing, but for a business. Graham suggests a two-step process. First, analyze the past. Look at the company's long-term earnings and dividend record. Has it been consistently profitable? Has it survived recessions? A company with a long, stable track record is like a house that has weathered many storms. It's proven its resilience. You want to see a history of earnings power? Second, you must value the future. But here's the critical part. You do not try to predict the future. That is a fool's errand. Instead, you project the past record forward, but with a heavy dose of conservatism. You ask, if this company just continues to do what it has been doing, what would its earnings be? Then, you take that estimated future earning power and you capitalize it. What does that mean? It means you decide what multiple of those earnings you are willing to pay. A stable, high-quality business might be worth 15 or 20 times its earnings. A more cyclical or lower-quality business might only be worth 8 or 10 times its earnings. This multiple is your judgment call based on the quality and stability of the business. Multiplying your conservative estimate of future earnings by your reasonable multiple gives you a rough estimate of the company's intrinsic value. This value is not a precise number. It's a fuzzy range. But this range is your anchor of reality. You then compare this calculated value to the current market price. Is the market price significantly below your calculated value? If yes, you have a potential opportunity. Is the market price far above it? If yes, you stay away no matter how exciting the story is. This is the essence of it. It's not about complex financial models. It's about looking at the history, making a conservative projection, and refusing to overpay. It's a framework for disciplined thinking, designed to keep you grounded in reality when the rest of the world is lost in hype. Chapter 12. Things to consider about per-share earnings. What is the most seductive number in all of finance? It's earnings per share, or EPS. This single number is plastered everywhere. It's what analysts obsess over. It's what drives stock prices up or down after a company reports its results. But Graham warns us, this number is not as simple or as reliable as it looks. It can be a dangerous trap. Think of EPS as the final score of a sports game. It tells you who won, but it doesn't tell you how they won. Was it a dominant performance? Or did they get lucky with a few fluke plays and some questionable referee calls? To be an intelligent investor, you have to look past the final score and watch the game tape. Graham points out that accounting is more of an art than a science. A company's management has significant leeway in how they report their earnings. They can use all sorts of tricks, creative accounting, to make the numbers look better than they really are. They can change depreciation schedules. They can recognize revenue early. They can use one-time asset sales to pump up the numbers for a single quarter. These are the fluke plays that can make a weak company look strong temporarily. So what's the solution? You have to be a skeptic, a detective. First, don't focus on a single year's earnings. That number is too noisy and too easily manipulated. Instead, Graham insists you average the earnings over a long period, like the last 7 or 10 years. This smooths out the bumps and gives you a much more realistic picture of the company's true underlying earning power. It's like judging a team based on their entire season, not just one lucky game. Second, dig into the financial statements. Look for the quality of the earnings. Are the earnings coming from the core, repeatable business operations? Or are they coming from one-off events and accounting gimmicks? Real cash flow is much harder to fake than accounting earnings. Pay close attention to that. Third, be wary of pro forma, or adjusted earnings. This is when a company tells you, here are our official earnings. But here's what they would be if you ignore all the bad stuff. This is a huge red flag. Always focus on the official, audited accounting numbers. The lesson here is profound. Don't be a passive consumer of financial data. Be an active, critical analyst. Question everything. Understand that the headline number, the EPs, is often a starting point for your investigation, not the conclusion. Your job is to find the reality behind the numbers. Chapter 13. A comparison of 4 listed companies. How do you put this analysis into practice? How do you move from theory to reality? In this chapter, Graham does something brilliant. He stops lecturing and starts demonstrating. Takes 4 real companies from his time and puts them side by side, analyzing them using the very principles he's been teaching. This chapter is a case study, a flight simulator for investors. It shows you the raw data, the prices, the earnings, the dividends, the debt tand. Then he walks you through his thought process. He's not just looking at the numbers, he's interpreting them. He's telling a story about each business. He looks at Company A and sees a long history of stable earnings and a reasonable price, a potential candidate for the defensive investor. He looks at Company B, a once great company that has fallen on hard times. He analyzes whether its low price is a true bargain or a value trap, a business in permanent decline. He looks at Company C, a fast-growing popular company. He acknowledges its impressive growth, but points to its sky-high price. He calculates that the price already assumes decades of flawless execution, leaving no room for error, a speculative risk. He looks at Company D, a smaller, more obscure company that the market seems to have forgotten. He digs into its balance sheet and discovers hidden value that the market isn't seeing. A potential candidate for the enterprising investor? The specific companies are not important. The process is everything. What you learn from this is how to think comparatively. An investment is never made in a vacuum. It's always a choice between alternatives. Is this company a better value than that company? Does it have a better balance sheet? A more durable business model? This chapter demystifies the process of analysis. It shows you that you don't need to be a Wall Street wizard. You need to be a disciplined, comparative thinker. You need to gather the facts, lay them out side by side, and apply the simple, powerful criteria that Graham has given you. Take two companies in the same industry. Pull up their key stats, their PE ratios, their debt levels, their dividend history. Which one looks more conservative? Which one is priced more reasonably relative to its history? This is the work. This is the practice. It's how you build the muscle of intelligent judgment. Chapter 14. Stock Selection for the Defensive Investor. Let's get back to the fortress builder, the defensive investor. We know the general principles, but now Graham gives us a concrete 7-point checklist for selecting individual stocks. This is your recipe for safety and simplicity. If a stock doesn't pass all 7 of these tests, you simply don't buy it, period, no exceptions. Here they are. 1. Adequate size. Avoid small companies. They can be more volatile and more vulnerable to disruption. Stick with companies that have a significant scale in their industry. This is a simple filter to weed out higher-risk situations. 2. Sufficiently strong financial condition. This is a check on the company's debt. Graham suggests that industrial companies should have current assets that are at least twice their current liabilities, and that long-term debt should not exceed the company's working capital. In simple terms, the company should not be drowning in debt. It needs a strong financial cushion to survive tough times. 3. Earnings stability. You want to see a history of consistent profitability, Graham demands. At least 10 years of positive earnings. A company that has lost money recently is not a candidate for the defensive portfolio. 4. Dividend record. This is proof of profitability and shareholder friendliness. Graham requires at least 20 years of uninterrupted dividend payments. A company that has shared its profits with owners for 2 decades has proven its durability and its character. 5. Earnings growth. Stability isn't enough. You need some growth to outpace inflation. Graham suggests a minimum increase of at least 1/3 in per-share earnings over the past 10 years. Using 3-year averages at the beginning and end to smooth things out, this isn't spectacular growth, but it's a test for steady, reliable progress. 6. Moderate price. Earnings ratio, don't overpay. This is the core discipline. Graham insisted that the current price should not be more than 15 times the average earnings of the past 3 years. This keeps you firmly in the realm of value and out of speculative territory. 7. Moderate price-to-book ratio. This is a second check on price. Price should not be more than 1.5 times the company's last reported book value. Graham sometimes combined this with the PE ratio, suggesting the product of the two should not exceed 22.5. This is a powerful, simple rule to ensure you are buying assets at a reasonable price. Does this list seem strict? Does it seem old-fashioned? Yes, that's the point. This is not a system for finding the next Tesla. This is a system for avoiding the next Enron. It is a discipline designed to produce one thing: peace of mind. By sticking to these rigid, time-tested criteria, the defensive investor systematically removes risk from their portfolio and all but guarantees a satisfactory, stress-free result over the long run. Chapter 15. Stock Selection for the Enterprising Investor. Now for the expedition leader. The rules here are less rigid, more flexible, but the intellectual standard is far higher. The enterprising investor is looking for value in places the defensive investor is forbidden to go. Graham doesn't provide a simple checklist here. Instead, he provides a set of mental models and approaches for hunting down bargains. The first method is a more liberal version of the defensive approach. You might look at a large, prominent company that fails one of the defensive tests. For example, a great company that has fallen on temporary hard times and has a recent loss. The defensive investor must avoid it. The enterprising investor can dig in, analyze if the problem is truly temporary, and if so, potentially buy a great business at a fire sale price. This requires deep business analysis. The second method is to look for bargains in secondary, less popular companies. These are not the giant industry leaders. They are solid, smaller companies that are simply off the radar of the big Wall Street institutions. Because fewer analysts cover them, they are more likely to be mispriced. The work here is to find these hidden gems and verify their financial strength and earning power. The third method is the classic bargain issue or net-net investment. This is the purest form of Graham's value investing. Look for a company that is trading at a price below its net current asset value. This means you are essentially getting the company's fixed assets, its factories, its real estate, its brand for free. It is the ultimate margin of safety. Finding these is rare and requires sifting through the unloved corners of the market, but the principle is powerful. Notice the theme. The enterprising investor is a contrarian. They are looking where others are not. They are buying when others are selling. They are analyzing businesses that are out of favor. This requires a unique temperament. You must be comfortable standing alone. You must have supreme confidence in your own analysis, because the market will be telling you that you are wrong. You must be patient, willing to wait months or even years for your investment thesis to play out. This is not about being smarter than everyone else. It is about being more disciplined, more patient, and more businesslike in your approach than everyone else. It is a demanding path, but for those with the right mindset, it can be exceptionally rewarding. Chapter 16. Convertible Issues and Warrants. Sometimes, companies issue securities that are a bit more complex. They're not quite a stock and not quite a bond. This chapter is a warning about these financial hybrids. Let's talk about convertible bonds. Convertible is a bond that you can, under certain conditions, convert into a specified number of common shares. It seems like the best of both worlds, right? You get the safety and income of a bond, plus the upside potential of a stock. Graham's take is simple. This best of both worlds promise is often an illusion. Usually, the convertible bond offers a lower interest rate than a regular bond from the same company. And the conversion price, the price at which the stock needs to. Before the conversion to be profitable is typically set well above the stock's price at the time the bond is issued. So what often happens? You end up with a low-yielding bond, and the stock never reaches the conversion price. You get the worst of both worlds. Graham's rule is this. A convertible should only be considered if its value as a straight-up bond is at least reasonably close to its market price. The conversion feature should be a free extra bonus, a lottery ticket. You should never pay a premium for that conversion privilege. Then there are warrants. A warrant gives you the right, but not the obligation, to buy a company's stock at a specific price for a certain period. Warrants are pure, undiluted speculation. Their value is entirely dependent on the stock price going up. They have no underlying asset value, no claim on earnings, no dividend. They are a high-leverage bet on price movement. For the intelligent investor, both defensive and enterprising, warrants are to be avoided completely. They are instruments of the casino, not the boardroom. The core lesson of this chapter is to be wary of complexity. Wall Street loves to invent new, complex securities. They're often designed to sound appealing while hiding risks and benefiting the issuer. The intelligent investor sticks to what is simple and understandable. Owning a piece of a good business or lending money to a solid enterprise, when a financial product seems too good to be true, it almost always is. Stick to the basics. Chapter 17. For extremely instructive case histories. How do things go wrong? Even with the best principles, how can investors lose their way and their money? This chapter is a post-mortem. Graham presents for fascinating real-world case studies of corporate drama and financial folly. These are cautionary tales designed to burn their lessons into your memory. He tells the story of Penn Central, a massive railroad company that collapsed into a shocking bankruptcy. The lesson? Size and prominence are no guarantee of safety. The company had a mountain of debt hidden in complex accounting, and management was overly optimistic right up until the end. This is a lesson in the importance of a strong balance sheet and a healthy dose of skepticism toward management's promises. He details the boom and bust of a conglomerate, a company that grew rapidly by acquiring other businesses. The market loved the ever-increasing earnings, pushing the stock to absurd heights. But the growth was an illusion, built on a shaky foundation of accounting tricks and overpriced acquisitions. When the growth stopped, the house of cards collapsed. This is a lesson in the quality of earnings and the dangers of paying for growth at any price. These stories are not just about numbers. They're about human psychology. They are about greed, hubris, and deception. They show how entire markets can get swept up in a narrative. Ignoring the deteriorating fundamentals right under their noses, reading these case histories is like a pilot studying crash reports. You learn what to watch out for. You develop a sixth sense for red flags. You learn that spectacular growth can hide spectacular risks. You learn that heavy debt is a killer. You learn that management's story can be very different from the company's reality. And you learn that the market can remain irrational for a very long time before reality finally reasserts itself. Often violently. These aren't just stories from the past. The names change, but the plots repeat themselves over and over again. Every market cycle has its own Penn Centrals, its own speculative bubbles. By studying these cases, you vaccinate yourself against the financial diseases of your own time. Chapter 18. A comparison of 8 pairs of companies. Let's sharpen our analytical skills one more time. This chapter is another masterclass in comparative analysis, but with a twist. Graham takes 8 pairs of companies. In each pair, the 2 companies are in the same industry. One is a large, famous industry leader. The other is a smaller, less prominent competitor. He then compares them head-to-head based on the numbers: earnings, growth, financial stability, and most importantly, the price the market is asking for each. What he consistently finds is fascinating. The market almost always puts a huge price premium on the larger, more popular company. It's perceived as safer, better, a blue chip. The smaller company, even if it has a stronger balance sheet and a better record of recent growth, often trades at a much, much lower valuation. The question Graham forces you to ask is that massive premium justified? Sometimes, maybe. But often, the market overpays for reputation and ignores the superior underlying value of the less glamorous competitor. The crowd gravitates toward the familiar name, creating a potential opportunity for the investor who is willing to do the homework. This is a powerful lesson for both the defensive and enterprising investor. For the defensive investor, it's a reminder that even when buying leading companies, the price you pay is paramount. Don't just buy a name. Buy it at a reasonable valuation. For the enterprising investor, this is a direct map to a hunting ground. The discrepancy in valuation between the popular leader and the solid button-loved secondary company is a prime area to search for bargains. The hard work lies in determining whether the secondary company is a true hidden gem or justifiably cheap. This chapter trains you to look beyond the headlines and the brand names. It forces you to be a financial scientist, comparing the data objectively. The market is a popularity contest in the short run. Your job is to ignore the popular vote and focus on the cold, hard business facts. Value is often found where popularity is not. Chapter 19. Shareholders and Managements. Dividend Policy. When you buy a stock, what have you really bought? You are not a ticket holder. You are not a fan. You are an owner, a partner of a real business. This chapter is about thinking and acting like one, and the central issue between owners and the people they hire to run. The business is a simple one: what to do with the profits. A company has 2 basic choices with the money it earns. It can pay it out to the owners as a dividend, or it can reinvest it back into the business to grow future profits. Management almost always prefers to reinvest. It builds their empire. It gives them more resources to command. They will tell you that reinvesting the money will create far more value for you in the long run. Graham is deeply skeptical of this. He says, "Show me the proof." If a company has a proven track record of reinvesting capital at high rates of return, then yes, it makes sense for them to retain the earnings. But many companies don't. They reinvest the profits into low-return projects, or worse, into foolish and overpriced acquisitions. In these cases, the shareholders would have been far better off if the company had just given them the cash as a dividend. This is where the intelligent shareholder must be vigilant. You are the owner. The profits belong to you. Look at the company's dividend policy. A company with a long, consistent record of paying dividends demonstrates 2 things. First, that it actually has real profits to share. And second, that its management respects the fact that shareholders are the true owners. Be wary of companies that pay no dividend and constantly sell you a story about a glorious future that will be funded by retaining all profits. That story might be true, but it requires a much higher level of scrutiny. The intelligent investor should favor companies that have a sensible balance. They reinvest what they can to generate profitable growth, and they return the excess to the owners. This is a mindset shift. You are not passively hoping the stock price goes up. You are an owner, monitoring how your hired managers are handling your capital. A steady stream of dividends is often the most honest report card you will ever get. Chapter 20. Margin of Safety as the central concept of investment. We have arrived. After 19 chapters of analysis, strategy, and psychology, Graham brings it all together into the three most important words in investing. Margin of safety. This is it. This is the bedrock. This is the central concept from which all other principles are derived. If you forget everything else, remember this. What is a margin of safety? It's simple. It's the difference between the price you pay for an asset and your conservative calculation of its intrinsic value. Imagine you're an engineer building a bridge. The bridge needs to hold a 10-ton truck. Do you design it to hold exactly 10 tons? Of course not. That would be insane. What if the truck is heavier than you thought? What if the steel isn't as strong as the specs said? What if there's a strong wind? You build the bridge to hold 30 tons. That 20-ton buffer is your margin of safety. It's what lets you sleep at night. Investing is the same. You analyze a business and calculate conservatively that it's worth $100 per share. Do you buy it at $95? No. You're paying close to full price, leaving no room for error, bad luck, or a change in the economic weather. The intelligent investor waits. They wait until Mr. Market, in one of his fits of panic, offers to sell that $100 per share business for $60. That $40 difference is your margin of safety. It is your protection against mistakes in your own judgment. It is your protection against unforeseen problems in the business. It is your protection against the wild, unpredictable swings of the economy. And here's the magic. The margin of safety is also the source of your profits. By buying a dollar for 60 cents, you have a built-in tailwind. Even if the business just muddles along, you're likely to do well as the price eventually moves closer to its real value. This one concept separates investing from speculating more than any other. The speculator buys a hot stock, hoping it will go from $100 to $200. They have no margin of safety. Their entire success depends on being right about the future price movement. The investor buys a $100 business for $60. They don't need to predict the future. They have a cushion. The future can be worse than they expect, and they can still come out okay. This is the ultimate source of confidence. It's the reason you can remain calm when the market is crashing. Because you know you bought your assets with such a large discount to their value that even a severe downturn is unlikely to impair your capital permanently. Every decision you make must be filtered through this question. Where is the margin of safety? If you can't clearly and conservatively identify it, you must walk away. This is not a technique, it is a philosophy. It is the guiding star for a lifetime of successful investing. We've been on a journey. We started in a place of fear and confusion, paralyzed by the noise of the financial world. And now, we stand here armed with a philosophy that is timeless, powerful, and clear. Think back to that feeling, that knot in your stomach. The feeling of being on the outside, looking in. That person is gone. You are no longer a speculator, chasing hot tips and praying for luck. You are an investor. You are a business analyst. You are an owner. You no longer see the market as a terrifying, unpredictable beast. See it as your partner, the manic-depressive Mr. Market, whose mood swings are not a source of fear, but a source of opportunity. You now hold the power to use his folly to your advantage. You are no longer confused by the thousands of choices. You know who you are? You are either the defensive investor, building an impenetrable fortress of wealth with simplicity and discipline, or you are the enterprising investor, the patient detective, hunting for value where others are too scared or too lazy to look. You have a toolkit. You know how to analyze a business, how to look past the deceptive headlines, how to demand quality, and how to refuse to overpay. And above all, you have your North Star, the three words that will protect you and guide you for the rest of your life. Margin of safety. It's your shield. It's your compass. It's the source of your confidence and the foundation of your returns. This is the transformation that Benjamin Graham offers. It's not a get-quick scheme. It is a get-rich-for-sure-if-you-are-patient-and-disciplined plan. And it's a path that trades the adrenaline of the casino for the deep, quiet confidence of the business owner. The work is not over. Reading this, watching this, is just the beginning. The real challenge is to live it. To apply these principles when your greed is telling you to chase a bubble, and when your fear is telling you to sell in a panic. The power is now in your hands. You have the blueprint. You have the mental operating system. The question is no longer what to do. The only question left is, will you have the character to do it? Will you be disciplined? Will you be patient? Will you be intelligent? I believe you can. The journey to financial freedom is a marathon, not a sprint, and you have just been given the map and the shoes to run it successfully. Start today. Build your fortress. Begin your expedition. Become the intelligent investor you were meant to be. If this journey resonated with you, if you had a breakthrough moment, share it in the comments below. What was the one lesson that changed everything for you? Subscribe for more deep dives into the ideas that shape our wealth and our lives. The masterclass is just getting started.